There are different ways to pay your mortgage off faster and to pay less interest. There's also tips that can just help someone with their payment. I'm going to discuss 6 different tips, and I'm actually going to go back and make individual videos showing you the number breakdown on these. For this video, I'm just going to discuss them in general. Now, the first thing I want you to know is I'm going to use a 30-year fixed loan for my example. And on a 30-year fixed loan, you make 360 payments. That's 30 years times 12. And the principal and interest payment is always the same every month. It's just that a portion goes towards interest and a portion goes towards the principal. Well, how it works is the interest you pay is based on the principal balance. Therefore, the interest amount starts out higher and goes down over time. As the interest amount comes down, the principal amount goes up. Now, the first tip I'm going to give you is just make extra towards your payment. When you have extra money, extra $50, extra $200, pay that towards your mortgage and make sure that you designate it towards the principal balance. Therefore, lowering your principal, you're going to lower the amount you pay on interest, and you're going to shorten the amount of time you have your loan for. Now, a tip that people love is to do what's called a bi-weekly payments. Now, the bi-weekly payments, what are great about them is instead of paying once a month, you pay every 2 weeks. And that every 2 weeks typically lines up with someone's paycheck. So it seems perfectly logical. This amount goes out of my paycheck towards my mortgage payment. The great news is over a year, you actually make 13 payments instead of 12. It actually gives you a little bit greater of a advantage than just making an extra payment. So you're going to slowly pay that off, and you're going to find that you pay your loan off years faster and you pay less interest overall. Now, another tip for you is to pay your mortgage as though it's a 15-year fixed loan. Oftentimes people can't afford a 15-year fixed loan because the payment is too great for them. But if you can, even with the debt to income ratio, if you can afford it yourself, you push yourself there. The great news is when you pay it like a 15-year fixed loan, you're not stuck with that payment. If something happens in life and you can't afford it, you don't have to pay that. But I can show you on an amortization schedule. Let me know and I can get you one where it actually pays the loan down so much faster and you pay so much less interest. Now, another tip for you is to make a lump sum payment towards the principal. This can happen. Maybe you're inheriting money. You change jobs and you get a big bonus. Well, instead of just taking that money and not knowing what to do with it, putting it in a bank, you can turn around and put it right towards your principal. So you now lower the amount that you owe on your loan. Therefore, that principal balance goes down. The interest you pay is less. And now the principal that you make every month goes up. Therefore, you're going to pay your loan off that much faster. You're going to pay way less interest over the amount of the time of the loan. Another thing for you to know is that you can refinance your loan. People think, I don't want to refinance and start over when rates drop, and they will drop again because they don't want to start at 30 years. You don't have to start at 30 years. If you've already made 4 years worth of payments, you can do a 26-year loan. You can do a 23-year loan. You can make your loan amount the number of years that you want. If your lender doesn't have that, call me. I have it. I can help you out with that. Last but not least is what's called a recast. If you are fortunate enough to have a 3% loan and you're like, I don't want to refinance because I've got this great interest rate, but now I've got this extra money coming in. I wish there was a way that I could keep my same interest rate, but lower my monthly payment by doing this. You can with what's called a recast. And how that works is, say you take a lump sum of money. Let's just say you had a $500,000 loan and somewhere you inherited $200,000. You could take that $200,000, apply it to the principal on a recast. Now your loan is based on only $300,000 with the same current interest rate that you have. It's not a refinance, and it drastically will lower your monthly payment. So it can put you in a much more comfortable situation. This is great, especially for people who are getting older and close to retiring when they get a lump sum of money. But it's just a great way that's out there. And the other thing that's nice about it is you don't have to make that lower payment. You can continue making the payment that you're used to, but you have it as a fallback. I hope these tips help. If you have any questions, if you want an amortization schedule, please give me a call, Tim Stafford, 949-355-3004. I'd love to help you out. Once again, I'll be producing some videos to walk you through these step by step. Have a great day.